Here we go. Today I'm going to be doing my first stock review of hopefully a long and prosperous series of stock reviews. I'll just get right into it, talk about the stock I'm doing, and then go through the checklist I made of the video that I did the other day that shows the whole checklist and everything. I'm just going to go through that with the stock. I'm going to try to keep it between 5 and 10 minutes so then I could bang out like 12 of these videos tonight and then post them all scheduled throughout the next like week or so. I think that would be ideal, but we'll see how it goes. Let's get into it. All right, so the first company I'm going to be starting with is Celsius, just because they're at the top of my list here. But so I'm going to start with them. Let me organize by that. And I just want to show more of the information. Well, whatever. So I'm going to start with them, go through the whole thing here. I will be making another video about my model, how I decide on the weights and all that. But for now, I'm recording this first just because I felt like it. So we're going to get right into it. Starting off, we're just going to go through each page, go through it, see how everything is doing, and then I'll have a final score, and then I have a table here that I will put all of the stocks that I rate in, just so I could kind of have them in like a organized list. So starting out, WAC below 11%, I said. So this is different for all companies. So I'm still going to give this the full score for it just because kind of a newer company. Well, no, I wouldn't say newer, but high growth company, you're probably going to see the cost of capital being a little bit more. This is literally one of the lowest ratings for it just because, target price. So good. So positive depends on the industry, usually 10%, beating inflation, long-term growth rate 23%. That's perfectly fine. So we are going right to the income statement. So sales growing consistently. I'm going to go to years just because it's going to be easier to visualize. So, Celsius, I've already looked at this personally, and their sales growth is just insane over the past few years. So I already know about that. Operating income growing, you could see that as well. Good. Net income looks like they're doing fine there. Keeping that. Growing EPS, same thing. And total shares, I want to see it decreasing. It looks like it's not really, slowly going up, but let's see the beginning. So that's in the last 10-ish years, 61 to 231. That is not the best. What I'm going to do, only because in the past, in the past 3 or 4 years, it really hasn't been crazy in terms of dilution. Now, if you go back 8-10 years where they doubled the amount of shares, tripled the amount of shares in a couple of years, that's not the best. But considering it's kind of slowed down the rate, they're really not doing it as much anymore, it looks like. I'm going to do a 0.5 here. I kind of have a high weight for some of these, like net income is very important. That has a higher weight. Total shares is kind of in the middle there, but let's go to the balance sheet. And this also just helps me be a lot faster. Just having this available, I know exactly what to look for right away. So growing cash, got it. Assets increasing, got it. Short-term debt should be they have almost nothing. That's perfect. Decreasing total debt. Considering their short-term and long-term is almost nothing, I'm going to give their liabilities are increasing, but I honestly don't even know. Miscellaneous. Deferred income, that's not necessarily a bad liability. So really, I'm probably going to, even though their liabilities are increasing, their short-term debt and their long-term debt aren't. So I'm still going to give the full point for that. And, actually just right now, I'm going to put ST/LT debt because that is a little more important for me. All right, retained earnings positive. Let's check that. So it looks like it is not, but they are fairly close. They've actually never had positive retained earnings, but again, you could see how low the weight is for this, so it's not the biggest deal in the world. But I think that's it for the balance sheet. Let's go to cash flow statement. Operating. Start with operating cash flow. Growing positive. Yes, perfect. That is very important. Investing cash flow. I would like to see that negative, which it is. Fantastic. Financing cash flow should be negative. Yes, it is. Recently negative, but still. It looks like they took out a lot of equity about 2 years ago, which isn't a terrible thing, but financing cash flow is negative now. Free cash flow should be positive and growing. Yes, it is, and it's actually growing a lot, which is fantastic. Got that. Repayment of debt. Let's go to the use of cash statement. They have recently gotten a ton of cash, and it looks like there's almost no debt servicing because they literally have no debt, which is fantastic. But what we want to see here is repayment of debt being larger than the issuance, which again, they have almost no issuance. So that is fantastic. Repurchase of stock should be negative and growing. So they really don't repurchase a lot of stock, which is not necessarily concerning, but it is a little strange considering they have a ton of free cash. They have a ton free cash flow. They have a ton of cash available. So it kind of sucks that they don't repurchase any stock, but that's not the worst thing in the world, just considering they have no debt, things like that. So not necessarily that bad, but yeah, that's it for that. I always do like to glance at the segment history just to see. So Celsius has had some massive sales growth over the last few years. I mean, it just visualizes a little bit better by their own personal segments. So I do like to take a glance at that just to see. Let's get right into the ratio analysis. So what I want to see is net margin increasing. It looks like it is. 2022 was a rough one. Let's see if we could go to quarters here and see what that looks like. So 19, 18, 17, 30. I mean, that's very good growth. Negative, negative, negative. So that's fantastic. Over the last 4 quarters, they've had a positive net margin. Keep that full. ROA, ROE is increasing. Doesn't necessarily have to be. I'm actually going to say here too, increasing slash consistent, only because it's still, if you have a 18% ROA 5 years in a row, that means you have an 18% return every single year for 5 years, which is fantastic. So it doesn't need to be increasing. So ROA, ROE is increasing consistently. That's fantastic. And then long-term debt to total equity should be decreasing, which it mostly is, but again, they have almost no debt, so this entire ratio is basically meaningless. So it's looking like they have 19.5 out of 22, 89.5, which is fantastic. So we'll start 89.5. Oh, 89.5. And then today's date. And that is the first entrant. Enter. What's the word for it? I don't know what the word for it is, but you know what, that's fine. So there we go. That is Celsius. They have a very, very high rating. I am going to organize it so that it is always by filtered by values. I might have to have multiple values in to be able to filter it better, but I'm always going to have the highest ones on top, or I might do it by date so that the most recent ones are on top, possibly, but we'll see. But anyway, that is the valuation for Celsius. Again, my session has expired. I do own a bunch of it myself, obviously, but I'm going to be going through my own portfolio first and then branching out to other stocks just to rate them, possibly add them to my portfolio, and just to give some information on them. So I believe that is it for this video. I'll see you in the next one.